The highest probable price when we have a gap lower is the reach up into the halfway point. And then we have to see how it trades there. What does that mean? Well, what I'm explaining to you here. The first pass here, look what the bodies are doing. Yeah, we closed above the consequent encroachment, then dropped down and rallied once more. We wicked above that high, but were the bodies giving you any confirmation that that was a higher high? Remember, the wicks do the damage. What was it doing? What type of damage is it doing? Knocking out anyone that went short here that had a stop loss just above it. Why don't we want the opening range to be filled entirely or close the gap when we're bearish? Because if it can't fill the gap, that means we're really, really bearish. Then that means what? If we take out that low, then we're likely to have a large range down day. Traded below its relative equal lows. That's the one I said, when it did that, I said, I'm done. I would be done for the day. I would turn my charts off and go do something else. Why? Because of the nature of the calendar. And then when this wild return all the way back up to what level? Where are the bodies at? Consequent encroachment of the opening range gap. The gap didn't get filled. This is the remaining portion of that gap. Left it open. That's exactly what you want to see. You don't want to see bullish order blocks trade below its mean threshold or halfway point. You don't want to see that. You want to see the upper half. That is the secret to it. Fair value gaps, you do not want to see a inefficiency closed in entirely. You don't want that. Why? Because it's telling you it's got someplace to be and it ain't worried about nickel and diamond, the price ranges that are left open. That's the signature that smart money looks for. That's what they're looking for. They're looking for measurements with their charts that tell them this is telling me we're done. I'm waiting for price to get into this range of inefficiency or take out this high where the buyers and sellers are going to be at by studying what price is recently done, where is it at right now, and where is it likely reaching for. And if you have those three things understood, and there's some times when you're not going to know that. Yesterday, when we were in all this mess in here, I didn't know if we were going to run to the buy side, and I didn't know if we were going to go to the sell side first. I wanted to see sell side taken first, because then that would have given me conviction to try to trade for the full closure of the gap. Why? Because it ran sell side, and the obvious would be completely close in the inefficiency, and then wait for FOMC to then roll over lower. Because it didn't happen. I gave you when we were right here. All right, we're about to roll over because everything is indicating that we have done all the work up and failed. Look at the bodies. Here's your body on that swing high. This wick, the bodies there are lower than that. You see that? Look at the bodies here. It's lower than those bodies. Those bodies here are lower than that. What's actually occurring there? Smart money is accumulating short positions. That's what that indicates. But that's what you're reading. You're waiting for that. And when you see these swing lows being taken out, relative equal lows, swing low taken, that right there tells you that we have a shift in market structure. Does that mean enter, go short right away? No. We're in a consolidation. You have to demand more information. So when you have a fair value gap and you're seeing the candlesticks bodies failing to get outside the other upper end of it after you had all this behind you in terms of backdrop, that's now giving you the capability to say, okay, the narrative is now in play. They've assumed short positions by knocking out long holders and stopping out anyone that was already short. Inefficiencies, that's where your real support and resistance is going to be. But the bodies are telling you the story. The wicks do the damage. Yes, they're allowed to trade outside that inefficiency. I'm expecting it to now roll over. I talked about the volume imbalance. I talked about the other volume imbalance. And when it traded there, I said, now we want to see it aggressively run. It's because it's going to be heavy now. It's going to attack where it's smooth. Where's the smooth levels at? It's these two relative equal lows. And then once it goes below here, then it should stay really heavy and quickly run for that sell side because they don't want to let them pull those orders. If they drop it slowly, anyone that had a long position that has a stop loss in here in the form of a sell stop, they'll get the picture and say, okay, this is probably going to be a losing trade. And that pool of liquidity will reduce in size. And if smart money has sold short up here, up here, up here, and up here, they won't have the liquidity to be counterparty to buy back from covering their short because it will evaporate because of the market just drifting lower. That's how you know when ICT says I'm expecting large ranges, it's because everything that's in play right now, all the damage is done and everybody's stuck on the wrong side. And the smart money is going to be looking to get out. So if they're short, they're going to be looking to take out a low or relative equal lows, because there's going to be pending orders in the form of sell stops, which is the exact opposite side of a short position being covered when they buy at the market or at a limit order below these lows. And that's why we drifted below that. And I said at that moment, I would be done. The lowest quadrant, mid gap. This is always the highest probable retest. Doesn't mean it will hit it. If it goes up and starts to break lower, then that means we are really bearish, and who knows how low we'll go. Everything's measuring strength and weakness, and if we can't reach the midpoint, which is that's the parameter, just like mean threshold is for an order block, just like consequent encroachment is for a fair value gap. That is your decision making level. Okay, it helps you measure, should you be really buying in that run? And said it another way, like say you don't have the experience or confidence to buy when the market's dropping down into a fair value gap, like you're still learning this. You can wait for that to happen on a higher time frame, and then if it supports price at the midpoint, or it doesn't go to the midpoint and starts rallying like you would like to see if you were bullish, then you can drop down into a lower time frame than that time frame. And the very first fair value gap you see traded into, enter on an institutional order flow entry drill. That means the lowest low of the candle that makes the high, the fair value gap that forms on the smaller time frame. Your limit order to buy would be there, because your expectation is an institutional order flow entry drill is a time where the market will go into a fair value gap but won't even trade to consequent encroachment. So now you're using the higher time frame fair value gap that supported the idea that you wanted to see directionally, and it gave you the signature in price action that it's not willing to hit its consequent encroachment but rallied sharply higher when you're bullish. Drop down to a lower time frame. So if you saw that form like on a 5-minute chart, and you looked at the first fair value gap that formed after that 5-minute chart's fair value gap formed and showed its willingness to go higher, buying the first institutional order flow entry drill, that's how you enter on that. And it's not chasing price. And you'll use the same stop loss mechanism, but using it on the institutional order flow entry drill time frame of the smaller time frame. So your risk is small. You're not chasing price. You're trading within the price delivery continuum. Everything is moving in sync, and all those signatures would be basically confirming what you'd be hoping to see in price.